Ever feel like keeping up with the world's twists and turns is, well, a marathon you didn't sign up for? Yeah, you're definitely not alone there. Today we're going to try and shortcut that for you. Yeah, we're diving into the escalating trade tensions between the United States and its key allies, particularly the European Union and Canada. Right. This all seems to stem from President Trump's second term and this fresh wave of tariff policies he's rolled out. So for this deep dive, we've sifted through, well, a stack of YouTube transcripts, news analysis, expert opinions, economic data, the whole lot. Exactly. And our mission here is really to pull out the core insights about this, rapidly evolving situation. We want to pinpoint the main players, what's driving them, and maybe review some of those surprising ripple effects you might have missed otherwise. That's the plan.
Okay, so let's unpack what's happening with the EU first. It seems like the president's return has really stirred things up across the Atlantic.
Oh, definitely. It led to this, multifaceted standoff triggered by some pretty swift actions.
What were the initial sparks based on the sources?
Well, our sources point to a couple of immediate things. First, that rather unconventional suggestion about potentially bringing Canada into the U.S. as the 51st state.
Right, I remember that. Seemed a bit out there.
It might have sounded casual, but it apparently triggered a genuine diplomatic rift and, crucially, led to Canada putting up retaliatory tariffs.
Okay, and towards the EU.
Then, focusing on the EU, President Trump voiced some pretty strong criticisms. Things about, unfair trade practices, imbalances in defense spending. It set a, let's say, confrontational tone.
And that tough talk quickly turned into policy, didn't it? I mean, the big one being that 20% tariff on goods coming in from the EU.
Yeah, that landed hard. The administration framed it as a necessary correction, leveling perceived unfair trade barriers.
But the EU isn't just taking it lying down. They seem to be shifting from just matching tariffs to, a different kind of counter strategy.
Exactly, and this is where it gets interesting. The EU's move is calculated. They're not just mirroring U.S. tariffs, although there are plans for some of that.
All right.
They're strategically targeting a domain where the U.S. is really strong. It's tech giants. But it's an area where maybe direct U.S. counter leverage is less effective.
So it's not just about taxes on goods.
Right. The key insight isn't just taxation. It's the EU using its regulatory power, its own rule book, to indirectly hit the market dominance of U.S. tech firms in a way tariffs maybe can't.
We're talking Google, Apple, Amazon, Meta, the big names. Companies making huge revenues in Europe.
Huge. Billions.
Yeah.
And the EU's thinking, it seems, is that their massive market size gives them real leverage over these firms, especially since, EU tech companies don't really have that same kind of foothold in the U.S. market.
Makes sense. So what specific measures are being proposed?
Well, the French finance minister, for instance, suggested using the EU's already tough data rules, GDPR, and the upcoming EU Data Act to apply pressure.
How would that work?
It could mean things like potentially forced data sharing with European competitors, maybe restricting cross-border industrial data transfers, and definitely significantly higher compliance costs for these American tech giants.
So really getting into the weeds of how they operate in Europe. It's not just data rules. There was talk of a digital services tax, too.
Yes, a specifically targeted tax aimed squarely at JFAM, Google, Amazon, Facebook, Meta now, Apple, Microsoft.
Right.
This levy could hit their app stores, cloud platforms, mobile services within the EU, all areas where U.S. firms are currently very dominant. The goal seems to be rebalancing that transatlantic digital trade.
And beyond digital, are there other sort of precision tools they might use?
The sources suggest maybe tightening environmental standards or selective industrial limits rather than just broad tariffs everywhere.
So more targeted.
Exactly. Focusing on sectors where the U.S. has a big trade surplus, like tech and services. Aiming for maximum impact, but trying to minimize the blowback on their own industries.
It sounds very carefully thought out. And they're stressing these are meant to be proportionate, reversible, aiming for dialogue.
That's the stated aim, yes. Dialogue, not deeper conflict. And as part of that, Brussels is also considering using its anti-coercion instrument, the ACI.
The ACI, what exactly is that?
Think of it like the EU's economic self-defense toolkit. It lets them hit back selectively without a full-blown trade war. It's a nuanced technical tool, but with potentially big teeth.
How might they use it here?
It could mean limiting U.S. companies' access to European government contracts, maybe even restricting their IP rights within the EU.
Interesting. So it's designed for responding to economic pressure from outside the EU.
Precisely. It allows a quick, proportionate reaction to things like discriminatory rules or subsidies.
So if talks break down over issues like, say, access to those U.S. CHIPS Act subsidies or Buy American rules.
The EU could potentially use the ACI to restrict exports of critical technologies that they need but feel are being unfairly excluded from U.S. programs. It's like having a deterrent ready, even if they hope not to use it.
Got it. So when we talk about targeting big tech, just how much do these companies rely on Europe? The numbers must be significant.
They really are. It highlights the dependence.
Let's run through some of them. Meta, Facebook, Instagram, they pulled in, what, $38.36 billion from Europe in fiscal 24?
That's right. Nearly a quarter, 23.32% of their global revenue. Huge.
And Google.
Google's revenue in the EMEA region, Europe, Middle East, Africa, but the lion's share was over $100 billion in 2024. Think search ads, YouTube ads. They're deeply embedded in European commerce.
Wow. Then Apple.
Apple reported $101.3 billion in European revenue in fiscal 24. That's about 26% of their total sales. And get this, their operating profit in Europe was $42 billion that year.
$42 billion profit.
Just from Europe.
Shows you the consumer demand. And don't forget Amazon. They group Europe into international. But that segment hit $43.4 billion in sales in just one quarter of 2024, up 9% year on year.
So even if it's not broken out exactly, Europe is clearly a massive engine for Amazon's growth. Absolutely. They keep investing heavily there. So the key takeaway really is, despite any regulatory headwinds, Europe is indispensable for these U.S. tech giants. That volume gives the EU real leverage here.
Okay, so we see the EU's strategy, the tech angle, the money involved. What about the overall transatlantic trade picture? What does that look like right now?
Well, it's still the world's largest bilateral trade relationship. Around $1.6 trillion in goods and services in 2023.
Huge numbers.
Within that, over $850 billion was in goods. The EU actually has a big surplus there, $157 billion mainly from machinery, vehicles, chemicals.
But in services.
Services, the US has the surplus $109 billion, and the investment ties are even deeper. $5.3 trillion in mutual foreign direct investment. It's incredibly intertwined.
But then came that 20% tariff from President Trump in April 2025. His justification was this claim that the EU imposes a, 39% effective barrier on U.S. goods? That figure sounds high.
It's been widely disputed. The European Commission itself says the average EU tariff on U.S. imports is only about 1%. The WTO puts it higher, maybe 4.8%.
So where does 39% come from?
It seems to be a rather simplistic calculation based purely on the overall trade deficit. And interestingly, in 2023, the U.S. actually collected more duties on EU imports than the EU did on U.S. goods.
Okay, so the basis is shaky. In response to the 20% U.S. tariff, the EU is playing its own retaliation, targeting $26 billion of U.S. goods.
That's the figure mentioned. And the sectors likely targeted are things like steel, agriculture, machinery. Some analysts suggest these are chosen strategically to hit politically sensitive spots in the U.S.
And beyond tariffs, as we said, there's the regulatory pressure on tech and that ACI threat hanging there.
Correct. They have multiple potential levers.
So what are the predicted economic consequences of all this? I mean, it can't be good for anyone in the long run, surely.
No, the forecasts are pretty concerning. The European Central Bank thinks Eurozone growth could shrink by 0.3 to 0.5 percentage points if this escalates.
That's significant.
Frontier Economics warns EU goods exports could fall by about $29 billion with that 20% U.S. duty. And even in the U.S., analysis suggests a 25% tariff on EU imports could cut overall American welfare by maybe 1.5%.
Ouch. And it's not just the overall economy, right? Specific sectors must be feeling particularly vulnerable.
Absolutely. Take cars. About 21% of EU vehicle exports go to the U.S., and 15% of U.S. car exports head to the EU.
And there are already some existing tariffs there, aren't there?
Yeah, interestingly, there's already a 25% EU levy on U.S. pickup trucks versus only 10% on European cars coming into the U.S. The reasons are complex, historical, but the auto sector is definitely in the firing line.
Plus the compliance costs for tech we mentioned earlier.
Right. Tighter EU data rules mean higher costs for U.S. tech firms operating there. That adds up.
Okay, stepping back from the pure economics, what about the broader geopolitical implications of this whole transatlantic spat?
There are several big ones. We're already seeing stock market instability. Investors worry about trade-driven stagflation.
Yeah, markets hate uncertainty.
Some analysts even think U.S. tariffs could accidentally benefit Chinese exporters by shifting trade flows, making things tougher for EU manufacturers.
Oh, interesting. An unintended consequence.
And this whole thing makes it harder for Europe to balance its relationships with both the U.S. and China. Brussels says it's ready for dialogue, but also ready to sustain countermeasures.
And the worst-case scenario.
Some forecasts put potential global economic losses at a staggering $1.4 trillion if this really escalates. And one surprising potential consequence we're seeing flagged is capital flight from the U.S., with Europe maybe becoming a sort of safe haven. That could really reshape global investment.
A $1.4 trillion hit. That's sobering. It sounds like the EU isn't just playing defense, though. They're actively trying to shape their own tech future.
Exactly. There's a really strong push in the EU for what they call technological sovereignty, reducing reliance on tech from the US and potentially China.
How are they doing that?
A key part is this Invest AI program. The goal is to mobilize $200 billion to boost Europe's AI capabilities, research, infrastructure, training.
200 billion euros. That's massive.
And a big chunk, 20 billion, is specifically for building 4 AI gigafactories.
Are European companies on board?
Yes, significant buy-in from the private sector. A coalition of companies pledged 150 billion for AI ventures. National governments are chipping in too. France announced a big plan.
What are the challenges, though? Can they realistically catch up with the US and China?
That's the big question. Matching the scale, the pace, getting enough private investment, coordinating across countries. It's ambitious, but it clearly signals the EU's determination to be a major global AI player.
Okay, so while the EU's pushing back economically and strategically, Canada is also responding pretty assertively. And there's this fascinating side story involving Tesla in Europe.
Yes, indeed. Tesla is facing, well, a mounting crisis in Europe. Sales are plummeting, and there's a significant consumer boycott picking up steam.
Why? What's driving that specifically?
It appears to be largely driven by CEO Elon Musk's increasingly controversial political stances. Many Europeans seem to view his positions as incompatible with their values.
Things like supporting far-right parties.
Exactly. His support for parties like the AfD in Germany, certain statements, it's provoked widespread condemnation. And that link between a CEO's politics and a company's sales is a really key, maybe unexpected consequence in our interconnected world.
And this isn't just noise online, right? It's hitting their actual sales numbers.
Oh, absolutely. The figures for February 2025 are stark. Germany down 76%, France negative 63.4%, Spain negative 5.4%, Sweden negative 46%, Netherlands negative 42.5%.
Wow. But are overall EV sales down in Europe?
No, that's the crucial point. Overall, EV sales are actually rising. So Tesla's plunge looks like a specific reaction to the company and its leadership, not a general market trend.
That's a strong reaction. And it goes beyond just not buying the cars.
That's right. Reports mention vandalism at showrooms, owners publicly regretting their purchase. Several companies, like the German drugstore chain Rossmann and energy provider Lichtblick, have actually removed Teslas from their corporate fleets.
Citing values?
Citing incompatibility with their corporate values, yeah.
It's clearly damaging the brand image significantly over there. And this European backlash must be affecting Tesla globally.
Yes. Their European market share is shrinking. Competitors, especially Chinese ones like BYD, are gaining ground. BYD even surpassed Tesla in revenue recently. Analysts warn if this negativity continues because of Musk's politics, it could seriously hurt Tesla long-term in a very ego-conscious and, well, politically engaged market.
Fascinating case study. Okay, shifting back to Canada, their response to U.S. tariffs seems pretty significant too, going beyond just consumer stuff.
Indeed. We're seeing major Canadian pension funds actively moving investments out of the U.S. and into Europe.
Which ones?
The Ontario Teachers Pension Plan, they manage a huge $266.3 billion, and the University Pension Plan, $11.7 billion. Both are increasing investments in Europe, looking at things like private credit, real estate.
Why the shift? What's the thinking there?
The main reasons seem to be worries about U.S. political and economic instability, largely linked to Trump's tariff policies. They apparently see better long-term opportunities and less competition in European markets, perceiving them as more stable right now.
So a broader reassessment of risk and opportunity. And looking ahead, the predicted impact of these tariffs by late 2025 suggests some pretty dramatic market shifts globally.
Yes, the projections point to significant realignments, with tariffs potentially hitting 10% generally and way higher, like 145%. on China.
145%.
Yeah, the S&P 500 in the U.S. is forecast to drop maybe 1.8%, while European stocks could surge up to 9%. Hong Kong tech could jump 30%.
That's a huge divergence. Suggests capital flight from the U.S.
Exactly. Europe potentially becoming that safe haven we mentioned, and likely a weaker U.S. dollar, stronger euro as a result.
A major reshuffling. And Canada's strategic moves go even deeper than pension funds.
Absolutely. Beyond finance, look at defense. That deal with Australia, up to $6 billion for the JOR radar system. That's about boosting Canada's own Arctic surveillance, reducing reliance on the U.S. there.
And other partnerships.
They've been actively increasing defense and trade deals with the EU and Southeast Asia since 2023, about $7 billion worth. There's a clear focus on the Arctic's strategic importance, resources, military activity.
So Canada's definitely diversifying, reducing dependence on the U.S. across the board. Now, amidst all this, there was that slightly ironic report about President Trump and Tesla's stock.
Yes, reports suggest President Trump vowed to buy a Tesla after the stock lost around $135 billion in market value. This was after a long slide and growing protests at dealerships.
But Tesla's problems seem bigger than just stock price, especially with Canada's direct tariff response.
That's a crucial development, yes. Prime Minister Carney announced Canada would match the U.S. with a 25% counter tariff on vehicles imported from the U.S. that don't comply with their trade deal.
And autos are huge for Canada's exports to the U.S.
Second largest export category, 93% goes to the U.S. So this matching tariff, it has massive implications for those deeply integrated North American auto supply chains. It's potentially a nightmare for the sector.
What kind of impact are we talking for, say, Tesla, Ford, GM in Canada?
That 25% tariff could radically change things. For Tesla, they had big sales, got incentives. Now those are canceled, plus the tariff. Could mean losses over $500 million this year, maybe a $2-3 billion hit to their market value.
Wow. And for Ford and GM?
They export key models from the U.S. Consumers could face price hikes of C$3,000 to C$5,000 per vehicle. That might push buyers to Asian or European brands, potentially cutting Ford GM's Canadian market share by 10-15%, billions in losses.
And the Canadian public supports this.
Yes, polls show high public support, around 70% for these counter tariffs. They see it as a necessary response to U.S. protectionism. That strong backing suggests the policy will likely stick, even if it shrinks U.S.-Canada auto trade significantly, maybe by 30% from its $80 billion level in 2024.
A major rift in the North American auto world. Okay, let's broaden out again. Global currency shifts, China's moves. What happened with the euro early in April 2025?
That was significant. In the first 10 days of April, the euro surged over 5% against the U.S. dollar. This happened right after the U.S. announced those blanket tariffs. It clearly spooked global confidence in the dollar.
The market reaction was severe.
Very. The dollar index dropped sharply. The S&P 500 lost about 10% in 2 days. That's $6.6 trillion in value gone. The Dow fell over 3,000 points. Treasury yields spiked.
And safe haven.
Gold surged, yeah. Classic flight to safety.
While the U.S. market was tanking, what was the EU doing on a broader economic front?
They accelerated efforts to strengthen trade deals with other partners. EU-Canada trade, for example, has grown a lot since their 2015 deal.
And monetary policy.
They're pushing ahead with the digital euro project, setting up currency swap lines with China, Japan, India, Asian nations. It signals a move towards greater monetary independence from the dollar.
And this fits a wider trend of de-dollarization we're hearing about.
Yes. The dollar's share of global reserves has been slowly falling 59.2% down to 57.4% by 2025. Central banks are adding more gold, yuan, even digital currencies. Countries are trying alternatives for trade payments too.
Like who?
India and the UAE trading oil in rupees. Brazil and China settling deals in yuan. The BRICS nations talking about their own currency, it's all part of that shift.
So the EU's retaliation is this multi-pronged strategy. Tariffs, yes, but also hitting U.S. tech hard.
Precisely. Beyond GDPR and digital taxes, they're looking at sector-specific rules for AI, EVs, batteries demanding transparency, CO2 tracking, proving lack of bias.
And that anti-coercion instrument is still on the table.
Still a potent threat, yeah. Restricting market access, potentially conditioning patent access.
And Canada potentially shifting oil exports away from the U.S.
That sounds big. It would be. Halting exports, eyeing Europe instead. That could really hike gas prices in the U.S. Northeast, given how much they rely on Canadian oil.
Meanwhile, China's reaction to the U.S. tariffs sounds drastic.
Yeah. Reports say China has essentially frozen all new investments in the U.S.
All of them. From what level?
It's a massive drop. From $46 billion back in 2016 to basically zero now. It's not just a slowdown, it's a strategic redirection of capital away from the U.S.
What are the consequences for U.S. businesses?
Already being felt. Some firms facing severe financial strain, needing high-interest emergency loans. And ultimately, these tariffs on Chinese goods mean higher prices for U.S. consumers, maybe $1,950 a year per household on average.
Plus broader economic impact.
Plummeting profits for S&P 500 companies, high inflation hitting 3.6%.
And specific projects are being hit.
Yes, big U.S. projects like Intel factories being paused or canceled due to that lack of Chinese investment. 62% of U.S. manufacturers report financial shortages.
Is capital actually leaving the U.S.?
Significant capital flight. $120 billion pulled from U.S. stock ETFs in just 90 days. It's not just China. Other big investors like Norway and Japan are reportedly cutting back too.
And this is happening with a potential debt crisis looming.
Yes, that's the worrying backdrop. $4.1 trillion in U.S. business debt maturing by 2026, and increasing reliance on high-yield junk bonds. It's a precarious situation.
It's striking how views on these tariffs differ, even among those you might expect to support them.
Indeed. Some initial support, even on outlets like Fox News, later gave way to concern as the negative impacts became clear.
Yes.
Some still defend them.
Yes, billionaire Howard Lutnick argued they protect American workers. But many top economists, Summers, Ricardo, Krugman, cited in sources, warned about trade wars, hurting competitiveness, basic negative consequences.
Even some Trump allies were critical.
Yeah, figures like Rand Paul voiced concerns about the economic and political damage, and the impact on U.S. exports is real beef exports to the EU and China, down over 30%, for example.
And the actual announcement of the tariffs sounded a bit chaotic.
The White House press conference described in the sources sounded, well, confused. Unexpected items, tariffed penguins, uninhabited islands, high baselines announced, cars, EU, Vietnam, Taiwan, all hit.
Apparently, the market plunged during the presser. Explanations seemed improvised, lots historical nostalgia about tariffs from centuries ago, mentions of groceries, forgetting to sign the order. It didn't inspire confidence.
And the international reaction was swift.
Strong condemnation from Germany, the EU, threats of retaliation hitting U.S. agriculture, tech, digital services, criticism from Canada, Japan, South Korea, talk of them seeking alternative partners, real potential for U.S. isolation.
Even backlash within the Republican Party.
Reports mentioned pushback in key states like Florida, Wisconsin, and that market collapse happened while the White House discussion reportedly shifted to third-term speculation instead of offering solutions to the instability.
Okay, so let's try to summarize this deep dive. What are the big takeaways?
Well, first, it underscores just how interconnected global trade really is. These U.S. tariff policies are causing significant upheaval, not just ripples, but potentially waves.
And the impacts seem far-reaching and possibly long-lasting, affecting trade, investment, currencies, even alliances.
Absolutely. And what's really noteworthy, I think, is the assertive strategic response from allies like the EU and Canada. They're not just reacting, they're showing resilience and pursuing their own interests pretty forcefully.
So it's not just the U.S. dictating terms.
It really feels like these actions could signal a fundamental shift, a change in how the U.S. can expect to interact with its closest partners on trade and economics going forward.
Which leads to that final thought for our listeners. Considering these fundamental shifts, how do you think this will ultimately play out for the global economy in the next few years?
Yeah, and with the EU and Canada pushing back so assertively, does this mark a real turning point in those relationships? Is this the new normal for how the U.S. engages with allies on trade?
Definitely a lot to chew on there. Thanks, everyone, for joining us for this deep dive.
We hope it gave you a shortcut to understanding these complex issues.
Absolutely. Keep exploring, keep thinking, and maybe share your own thoughts on where this might be heading.